better than expected December CPI print. My next guest says this morning's report could be a good sign for the months to come. Joining me now with his market outlook and his best stock ideas for this month is Fundstrat Global Advisors Tom Lee, a CNBC contributor. Welcome back.
Great to see you, Scott.
All right, first, your view right now on this market is what?
I think that markets are showing some relief that CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI. So it's setting the stage for yields which kind of were close to touching 5% to kind of cool. And at a time when sentiment's been negative, I think we should be rallying.
Is the Fed back in the game? Which means this report was good enough, these two reports, really, as some are saying that, okay, you're not going to get a cut in January, but you could get one in March. And some people had written cuts off for many, many months.
Yes. Into this CPI print, the whisper number for core CPI was over 0.3. So the market was bracing for a really hot number. And you could see it in the Fed fund futures where, as of yesterday, there was a 30% plus chance of a Fed hike. I think those sort of extreme views have been quelled. And I just think generally, without accounting for the fact that the California fires could mess with inflation, the inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. How optimistic are you for the type of return we could do this year after back-to-back, 20+% gains for the S&P?
We've gotten some good harbingers so far because the first 5 days of this year, the S&P is positive. So I'd say there's an 80% chance of something over double digits for the year. And what's going to matter to a lot of people is how we do for the month of January. But as of January 15th, we're up 0.7%. So those are good harbingers for the year.
Can we have a good year if the Fed doesn't cut until later in the year and bond yields remain elevated for a while?
If bond yields get stuck here, it is a severe tightening of financial conditions. And I think it's going to hit housing, and we're already seeing it now. So I think it is important for yields to move directionally lower.
That's a long way of saying stocks will not be good if bond yields stay where they are now?
Yes, it's going to test the market's resolve. I don't think it kills equities, but it's hard for someone to be pounding the table if they think yields are going to be stuck at close to 5% for the next 6 months.
Wow, so if yields, let's just say they stay near where they are now, you wouldn't be as optimistic as you are?
I think it's going to raise concerns there's a policy error from the Fed, that either financial conditions are too tight or the bears will argue the Fed made a mistake cutting too aggressively last year.
But isn't this the base case? I mean, you have what is arguably a more inflationary environment because of some of the policies that are being talked about by a new administration. Sure, they may stimulate more economic growth, but with that potentially comes more sticky inflation too.
Well, there isn't necessarily a connection between growing faster and more inflation. There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation. It's the reinflation trade based on some of the expected policies that may cause that.
True, but to keep in mind, last year's inflation, first of all, a lot of last year's inflation was what they call imputed because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. So I'd say that it's difficult for me to make the case inflation's getting strong.
The bustling corridors of Wall Street were sent into a whirlwind following last Friday's unexpected turn of events. A stronger-than-anticipated jobs report threw a curveball at investors, shaking the very foundation of stock futures on Monday morning. Your favorite indices took a nosedive in pre-market trading, steering all eyes towards seasoned players like Nvidia, Advanced Micro Devices, and Palantir Technologies. But just how deep does the rabbit hole go? Welcome back to Investocracy.
Let's talk about the stock market and the broader markets. Major indices coming off their best day since the day after the election. Stocks jumped following a cooler than expected inflation data. Joining us now, Mark Newton, FundStrat Global Head of Technical Strategy. And you're fairly constructive, I think, Mark. But your one concern is breadth. And we talked earlier with someone about perhaps interest rates either staying where they are or at least not coming down, which is not great for the small caps. So I don't think there's no relief in sight for you.
Yeah, thank you, Joe. Happy New Year. Breadth did get hit very hard starting last fall. We saw declines in healthcare. Just in the last month, we saw really 7 sectors lost more than 4%. So, the percentage of stocks right now above their 50-day moving average is down to about 25%. So it has been a very hard-hit market in the last month. The one saving grace is that technology, to its credit, came back and actually has helped the broader indices remain afloat. So long-term trends actually remain in very good shape. It's more just near-term breadth deterioration, as well as I think sentiment has also gotten abnormally, pessimistic regarding the potential plans for, the president-elect's policies, which many of those we don't even really understand the extent to which that could be inflationary, and there's a lot of forces that go against that.
Happens, yeah, what becomes law or is actually done. But it still seems like you're saying, look, the indices are holding up, even though if you lift up the hood, what's going on is not great when you look at the detail. You still like 6650 for the S&P, though?
Well, it's just January. That's my year-end target. I do think that's going to be hit. Interest rates have gone up for reasons I think that many don't understand. Some of those have to do with longer-term Treasury supply and the incoming Treasury Secretary's plans on potentially funding some of this debt in longer treasuries.
Yeah.
So these things aren't necessarily. We saw yesterday by the CPI data that wasn't necessarily inflationary. I think that's in the rearview mirror for the Fed, honestly. So the reasons why Treasury yields have been spiking don't necessarily have anything to do with what the common narrative is. My view is that rates are going to start to roll over in the months to come. That should be bullish, just given the recent correlation. Treasuries and equities have been moving almost in unison, and so I think that is going to continue for the time being. All equity, investors need to be concentrating on what's going on with yields, more so the velocity of yields. If they were to spike above 5%, that would be a short-term concern for the market, but we haven't seen, substantial trend damage to think that any of our upside targets that we set last month are going to be derailed.
Friday's session on Wall Street unwound weeks of gains that had been carefully accrued since the last election. The robust jobs report, which saw an addition of 256,000 jobs in December, far beyond the economists' forecast of 165,000, was both a boon and a bane. As the report rolled in, market dynamics shifted dramatically. As analysts dissect the data, the crux of the matter hinges on how bond yields have reacted yet again. The sturdy 30-year Treasury was yielding 4.95%, and during intraday transactions, it peaked above the 5.0% threshold, a number not seen often outside inflationary panic. Similarly, the savvy 10-year Treasury note flitted around at 4.78%, settling at 4.76% by session's end. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
We've had other guests on just today that almost said things that were in direct opposition to what you just said. It's expecting inflation either to stay sticky where it is or even move higher, potentially, and for interest rates to at least stay where they are, possibly move higher. You think the corollary, or you think the other situation happens?
I think things are a little bit overbaked with regards to yields having pressed up.
And inflation, too. You think inflation is under... You said that it's in the rearview mirror for the Fed?
I think that's absolutely correct.
Really?
When you look at the factors that make up, inflation with regards to shelter,
then he mentioned shelter being the sticky
What about
point.
energy?
Yeah, $80 oil.
Look, I think the incoming administration's plans are to ramp up production by at least over 3 million barrels a day. That's going to be something that's going to cause crude oil likely to fall down to 50, potentially 40. That's my target. So I'm actually underweight energy for the year. I don't think that's going to be a big deal. That's going to cause further disinflationary pressure. And I think China is something that nobody's talking about. I mean, they're entering a time when it could be a very deflationary time, not unlike Japan was in the 90s. Their interest rates are down 300 basis points below Treasury yields. So that's something that they're going to need a lot of stimulus to be able to help their economy recover. Those are factors that are going to offset any potential tariffs being inflationary, in my view.
According to Louis Navellier, when you hear Trump 2.0, tariffs, and inflation fears in the same breath, you're likely witnessing the market's natural overreaction. His pitched advice dripped with the urgency of a sage awaiting specifics from the Federal Reserve. Yardeni and Wallerstein echoed similar sentiments, terming the market's turbulence a buying opportunity, confidently stating their conviction in specific points for the S&P 500. With Nvidia, AMD, and other notable stocks like Palantir in the spotlight, the tech-centric skids experienced only fortify the tale's intrigue. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in FundStrat Head of Research and FundStrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is, it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
In closing, the present state offers fertile grounds for strategic investments, especially if you have your eyes on high-valuation tech stocks. Supported by strong economic forecasts and the market's intrinsic pullback behavior, the current dip is less of a reprimand and more of an invitation. But what's your stance? Are you ready to seize the opportunity, or is caution still the name of your game? Share your thoughts. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.